this was the announcement we were waiting for. It's much trailed on the way into the autumn budget statement, and this was what help could be given along the lines of stamp duty land tax relief. What we've been given is a relief which means that for the first £300,000 spent on a property, there's absolutely no stamp duty land tax. Now, it only applies if the overall amount spent on the property is less than £500,000, and it only applies if you've never previously owned a property in the UK or elsewhere. So it is limited to an extent, but it would give, on a property being bought for £500,000 exactly, it would give a £5,000 stamp duty land tax saving. It's fine, it's further than we thought the Chancellor would go. It's going to be an expensive measure. It will cost the Treasury forecast around £600 million a year. But there are some problems with it, and the problems really are going to be most felt in London and the South East. If somebody is spending more than £500,000 on a property, so for example if they're spending £1 more than £500,000 on a property, the additional £5,000 of stamp duty land tax will be payable. So in the most absurd situation, you'll be buying a property for £500,001, and on that additional £1 your rate of stamp duty land tax is 500,000%. So that cliff edge is not helpful for the property market, and we'd largely eliminated cliff edges in the stamp duty land tax regime in recent years, and we've just introduced one back again. We'll see what effect that has on the property market. Right, some of the announcements, and we had precious few before the budget to warn us what was coming. One of the announcements was that the Chancellor was going to look at the Enterprise Investment Scheme and similar schemes, the Venture Capital Trust and Seed Enterprise Investment Scheme, and just look at possible areas of abuse. One of the areas where we thought there may be some attention was EIS when applied to film production companies. Thankfully they were left alone, but what we have is a general attack on EIS schemes where they're put together with what's called capital preservation strategies in mind. Typically this is going to be bricks and mortar companies, so you're investing in a trading business but happens to operate from a property, and therefore even if the trading business fails, you've preserved your capital because you still own the bricks and mortar investment. Now that's fine as far as it goes, in that some of those schemes which were put together were only put together to benefit from the tax relief. The trading business wasn't really one that had any longevity or chance of commercial success. However, there are going to be plenty of proper trading businesses that operate from a property, and as with any anti-avoidance rule, if the net is cast too wide, we're going to end up denying some businesses the ability to raise money under this valuable scheme, which is going to be pretty harmful to promoting those businesses in the economy. We were expecting the gig economy and modern working practices to get some attention in the Chancellor's speech, partly because we had the Taylor Review earlier in the year which examined modern working practices and whether the current tax and legal system was fit for purpose given how much things have changed. What we had was two announcements. One was a review of employment status generally. This is a direct consequence of the Taylor Review, so we've got no news yet, but we may find that the tests of what determine whether somebody is employed or self-employed will be made more difficult to manipulate. Particularly in the Taylor Review, it did say that the tests were quite easy to fall one side or other of the line, and that was causing people who perhaps should have been employed to be treated as self-employed. So that was one point. The other point, which has been predicted for some time and now looks to be inevitable to coming in, even though it's only a consultation at the moment, is extending the off-payroll rules in the public sector to the private sector. Now what this means is if you're a normal private sector business and you choose to use a contractor who provides their services through a limited company, you will need to consider whether you should be deducting PAYE income tax and national insurance from the payments you make to that limited company. This would stand in place of the IR35 rules. There is going to need to be a lot of consultation on this, so we'll watch this space. If it does come in, it could come in April 2019. We had an announcement from the Chancellor that there was going to be further support for research and development for large companies. This is all about the research and development expenditure credit. This gives a repayable credit to large companies, and it's gone from 11% to 12%. Well, what does this mean in real terms? It really means for every £100 a large company spends on research and development, it was getting back £8.91. It's now going to get back £9.72. In the grand scheme of things, it's reasonably small beer. The Treasury are forecasting this is only going to cost them about £60 million a year, which in Treasury terms is not a lot of money. So it's a reasonably minor announcement, given that the Chancellor couched his whole speech in terms of supporting the technology sector. You can see why this announcement was in there. What was disappointing is it only benefits large companies. The only reference to research and development for SMEs, the small and medium-sized businesses, was that the revenue, the HM Revenue and Customs, would run a campaign to raise awareness of the research and development scheme for SMEs, which I think most commentators would argue is not really necessary because there's plenty of awareness out there already. Well, there was a big surprise for the property sector, and this didn't even feature in the Chancellor's speech. Now, you can read into that what you want, whether it was a late decision to include it or not, but what we've got is an extension of the regime which applied to residential property from 2015. From April 2015, non-residents owning UK residential property started to pay capital gains tax. Huge change in the tax system makes UK residential property a less attractive investment for overseas investors. However, it was limited to residential property. What we've heard today is that that will be extended to commercial property. It's only a consultation, but consultations have a degree of inevitability behind them. And from April 2019, the proposal is that all non-resident owners of commercial real estate, so the office buildings around the country, will be within the charge to UK tax. It will only be on growth from April 2019 onwards, so there is going to be a rebasing, but it does dramatically change the economic factors that an overseas investor might consider when investing in UK property, and will make UK commercial property less attractive as an investment. I don't think it will cause a wholesale selling of property, but it will have an effect on the market in the long term. Closer to home, there was another announcement, which is that indexation relief, which removes the inflationary element of capital assets. So for capital assets growing only by virtue of inflation, indexation strips that out, so when it's sold you wouldn't pay tax. That indexation allowance is now stopping in January 2018. And from that point onwards, it won't be given, and it will mean that companies will be paying more tax. This includes UK companies on properties that are sold in the future.